Hello everyone and welcome to Educare 247. This is the fifth lecture in the series on economic and social issues, and today we'll be covering MCQs related to fiscal policy. This lecture is important for RBI, NABARD as well as SEBI Grade A 2020 examination. Now before moving forward, Educare 247 brings you SEBI Grade A 2020 crash course which features around 5000 plus MCQs with concise content and live doubt sessions. So you can log onto the website and apply coupon code SEBI to get 1500 rupees off on the course. Now before moving on to the MCQs, let us understand more about the term fiscal policy. Fiscal policy in India is the guiding force that helps the government decide how much money it should spend to support the economic activity and how much revenue it must earn from the system to keep the wheels of the economy running smoothly. In recent times, the importance of fiscal policy has been increasing to achieve economic growth swiftly, both in India and across the world. Attaining rapid economic growth is one of the key goals of the fiscal policy formulated by the Government of India. Fiscal policy, along with the monetary policy, plays a crucial role in managing a country's economy. It is through the fiscal policy the government of a country controls the flow of tax revenues and public expenditure to navigate the economy. If the government receives more revenue than it spends, it runs in a surplus. While if it spends more than the tax and non tax receipts, it runs into a deficit. To meet additional expenditures, the government needs to borrow domestically or from overseas. Alternatively, the government may also choose to draw upon its foreign exchange reserves or print additional money. For example, during an economic downturn, the government may decide to open up its coffers to spend more on building projects, welfare schemes, and providing business incentives. The aim is to help make more of productive money available to the people, free up some cash with the people so that they can spend it elsewhere, and encourage businesses to make investments. At the same time, the government may also decide to tax businesses and people a little less, thereby earning lesser revenue itself. The main objectives of fiscal policy in India includes economic growth. The fiscal policy helps maintain the economy's growth rate so that certain economic goals can be achieved. The next objective is price stability. It controls the price level of the country so that when the inflation is too high, prices can be regulated. The third objective is full employment. It aims to achieve full employment or near full employment as a tool to recover from low economic activity. Understanding the difference between fiscal policy and monetary policy. In this case, the government uses both monetary and fiscal policy to meet the country's economic objectives. The central bank of a country mainly administers the monetary policy. In India, the monetary policy is under the Reserve Bank of India or the RBI. Monetary policy majorly deals with money, currency, and interest rates. On the other hand, under the fiscal policy, the government deals with taxation and spending by the center. Moving on to the MCQs, which of the following may contribute in increasing fiscal deficit? And the options are A. Building of roads by the government agency. Second, implementation of the State Pay Commission. And the options are A. 1 only, B. 2 only, C. Both 1 and 2, or D. None of them. So the correct answer here is C, that is, both 1 and 2. As the construction of roads by a government agency at any tier will use public investment, it will crowd out the private investment as well. This is one particular reason due to which most of the construction is done through a public-private partnership mode. Let us understand more about fiscal deficit. Government in many countries run persistent annual fiscal deficits. A budget deficit occurs when tax revenues are insufficient to fund government spending, meaning that the state must borrow, usually in the form of government bonds. Why do countries run large or often semi permanent fiscal deficits? A number of reasons can be put forward. Some of them can be short term, while others can be linked to structural, deeper fiscal issues facing one or more countries in particular. There can be cyclical reasons. For many countries, a rising budget deficit is the inevitable result of experiencing a recession or a sustained period of slow growth. In a downturn, revenue flows fall from direct and indirect taxes, while at the same time the government is required to pay out more in welfare benefits, such as the means tested income support, unemployment benefits, and other welfare handouts. So, part of a fiscal deficit may be the consequence of the automatic stabilizers at work. These are the tax and government spending changes that happen automatically at different stages of the business cycle. The governments of most developed countries are prepared to allow the automatic stabilizers to work through because when their economy recovers, the cyclical component of a fiscal deficit will diminish. There can be structural reasons for fiscal deficit as well. For some countries, fiscal deficit seems an almost permanent feature, and rarely the government is able to find enough tax revenues to cover the annual spending budgets. It can be due to high levels of tax avoidance and tax evasion. It can also be due to high levels of income and wealth inequality. Some economists argue that high unequal societies also end up with worsening fiscal position for the government. The rich are liable for higher taxes in a progressive system, and the top rate taxpayers clearly pay a high percentage of the total revenues, but they also have an incentive to use all of the legal tax avoidance schemes open to them. At the bottom end of the labor market, if millions of people are in low paid, insecure work, many will not earn enough to pay much in tax and even may remain dependent of the top up welfare benefits, adding to the pressure on government spending. It can also be due to the government inefficiency. If the state sector is relatively less efficient in supplying public services, then value for money will be lower and more will have to be spent in total to provide the cover that people need. Free market economists favor a small government sector with many activities outsourced or privatized to the private sector to supply. Another reason may be higher levels of government subsidy or financial support. Over time, total government spending can rise because of the many competing demands placed upon politicians and the effects of lobbying by pressure groups. In some countries, public spending is bloated by very generous systems on farm, food, and energy subsidies that are politically hugely difficult to remove. The state might also get locked into providing financial support for loss making businesses and industries such as airlines. Moving on to the next question. Which of the following action or actions can be taken by the government to reduce the deficit budget? And the options are A. And the options are first, reducing revenue expenditures, second, introducing new welfare schemes, third, rationalizing subsidies, or fourth, reducing import duty. And the options are A. One only, B. Second and third, C. First and third, or D. All of the above. So the correct answer is C. That is only 1 and 3. In the case of statement first, that is reducing revenue expenditure, unnecessary revenue expenditure will bloat the fiscal deficit, and since it forms the majority of government spending, its reduction has a very large effect on the fiscal deficit. While in case of the third one, that is rationalization of subsidies, as subsidies are a major component of government spending, its reduction will cut down on the fiscal deficit. In summary, there are three main policies to reduce a budget deficit, which includes cutting down on government spending, second one is increasing of tax, and third one is to achieve a faster economic growth. A budget deficit occurs when a government spending is greater than the tax revenues. This leads to accumulation of public sector debt. If the deficits are unsustainable, this can cause a rise in bond yields, that is, higher interest payments, and in the worst case can lead to a loss of confidence in the government, though this is quite rare for countries with their own currency. The obvious way to reduce a budget deficit is to increase tax rates and cut government spending. However, the difficulty is that this fiscal tightening can cause lower economic growth, which in turn can cause a higher cyclical deficit. That is where the government gets less tax revenue in a recession. The best way to reduce fiscal deficits depends on a situation in a country is in. So the different policies to reduce a budget deficit includes cutting down on government spending. It also depends on the type of the government spending it is being cut down. If you cut down on pension spending, then there may be an actual increase in productive capacity. If you cut public sector investment, it will have a bigger adverse effect on aggregate demand and supply side of the economy. Therefore, the temptation is for the government to cut benefits and pensions, as this can reduce spending with less impact on economic growth, but it will be at the cost of increased inequality in the society. The second option is to increase the taxes. Higher taxes increase revenue and help to reduce the budget deficit. Like spending cuts, they could cause lower spending and lead to a fall in economic growth. Again, it depends on the timing of the tax increases. In a recession, tax increases could cause a significant drop in spending. During high growth, tax increases won't harm spending as much. It also depends on the type of tax you increase. While the third one is economic growth and is one of the best ways to reduce the budget deficit as a percentage of the GDP. If the economy grows, then the government will increase tax revenue without raising taxes. With economic growth, people may pay more. The companies pay more corporation tax and workers pay more on income tax. High economic growth is the least painful way to reduce a budget deficit because you don't need to raise tax rates or cut down the spending. In some circumstances, the countries may also be eligible for a bailout from an international organization such as the IMF. This means they can draw on temporary funds to help the temporary liquidity shortages. The bailout may reassure investors and give a country more time for dealing with the deficit. Moving on to the next question. Which of the following statements best describes external debt? A. It comprises of all foreign currency denominated debt owned by Indian companies and residents only. B. It comprises of all foreign currency denominated debt owned by the central and state governments only. C. It comprises of all foreign currency denominated debt owned by central and state governments, Indian companies as well as Indian residents. Or D. None of the above. So the correct answer here is C. That is, it comprises of all foreign currency denominated debt which is owned by the central governments, state governments, the Indian companies as well as residents. It includes loans, including interest which must be paid in the currency in which the loan was made. To earn the needed currency, the borrowing country may sell and export goods to the lending country. It is also referred to as a foreign debt. In many instances, external debt takes the form of a tied loan, which means the funds secured through financing must be spent in the nation that is providing the financing. For instance, the loan might allow one nation to buy resources it needs from the country that provided the loan. External debt, particularly tied loans, might be set for specific purposes that are defined by the borrower and lender. Such a financial aid could be used to address humanitarian or disaster needs. For example, if a nation faces severe famine and cannot secure emergency food through its own resources, it might use external debt to procure food from nation providing the tied loan. If a country needs to build up its energy infrastructure, it might leverage external debt as a part of an agreement to buy resources such as the materials to construct power plants in underserved areas. Also, a debt crisis can occur if a country with a weak economy is not able to repay the external debt due to an inability to produce and sell goods and make a profitable return. If a nation is unable or refuses to repay its external debt, it is said to be in sovereign default. This can lead to the lender's withholding of future releases of assets that might be needed by the borrowing nation. Such instances can have a rolling effect. The borrower's currency may collapse and the nation's overall economic growth will stall. The conditions of default can make it challenging for a country to repay what it owes, plus any penalties the lender has brought against the delinquent nation. Default and bankruptcies in the case of countries are handled differently than defaults and bankruptcies in the consumer market. It is possible that countries that default on external debt may potentially avoid having to repay. Moving on to the next question. Which of the following is or included in the capital budget of the Government of India? First, expenditure on acquisition of fighter aircraft. Second, financial assistance received from the World Bank. Third, loans made to foreign governments. Fourth, grants given to states and union territories every year. So the options are A, both 1 and 2, B, second and third, C, all of them, or D, 1, 2 and 3. So the correct answer here is D, that is 1, 2 and 3. It includes expenditure on acquisition of a fighter aircraft, financial assistance received from the World Bank, and loans made to foreign governments. Understanding more about capital budget, it consists of capital receipts such as disinvestment, borrowings, loan from public or foreign governments such as the RBI, and capital expenditure like expenditure on development of machinery and health facilities. Capital budgeting comprises of two words, capital and budget. It implies setting targets for projects and schemes to ensure maximum profitability. Parts of a capital budget includes receipts, and expenditure. The capital receipts refer to incoming cash flows. They can be both in the form of debt as well as non-debt receipts and also includes loan from the general public, foreign governments and RBI. Example of capital receipts include recovery of loans and advances to state governments, disinvestment proceeds, the money accrued to the government from issue of bonus shares, etc. While debt receipts are those which the government needs to repay along with interest. Most of the government's capital receipts are debt receipts. They are shown on the liability side in the government's balance sheet. Coming to the capital expenditure in the union budget, it is the expenditure on development of machinery, equipment, building health facilities, and acquisition of assets such as land. While the examples of capital expenditure includes loans given to the governments to states and public sector undertakings, loans that were taken in the past but are now returned, and spending on infrastructure, machinery, land, and road, etc. Moving on to the next question. Which of the following are components of public debt? First, public borrowing. Second, treasury bills. Third, securities issued by the RBI. And the options are A, one only, B, both 1 and 2, C, second only, or D, all of them. So the correct answer here is D, that is all of them, that is public borrowing, treasury bills, and securities issued by the RBI are components of public debt. Public debt is the total amount borrowed by the government of a country. So why is it significant? In the Indian context, public debt includes the total liabilities of the union government that had to be paid from the Consolidated Fund of India. Sometimes the term is also used to refer to the overall liabilities of the central and state governments. However, the union government clearly distinguishes its debt liabilities from those of the states. It calls the overall liabilities of both the union government and states as general government debt or consolidated general government debt. Since the union government relies heavily on market borrowing to meet its operational and developmental expenditure, the study of public debt becomes key to understand the financial health of the government. The study of public debt involves the study of various factors such as debt to GDP ratio and sustainability and sources of government debt. The fact that almost a fourth of the government expenditure goes into interest payment explains the magnitude of the liabilities of the union government. Coming to the types of public debt, the union government broadly classifies its liabilities into two broad categories. The debt contracted against the Consolidated Fund of India is defined as public debt and includes all other funds received outside Consolidated Fund under Article 266, subsection 2 of the Constitution, where the government merely acts as a banker or a custodian. The second type of liabilities is known as a public account. Speaking of internal versus external public debt, over the years, the union government has followed a considered strategy to reduce its dependence on foreign loans in its overall loan mix. Internal debt constitutes more than 93% of the overall public debt. Also note that external loans are not market loans. They have been raised from institutional creditors at concessional rates. Most of these external loans are fixed rate loans and free from interest rate or currency volatility. Internal loans that make up for the bulk of the public debt are further subdivided into two broad categories, which includes marketable and non-marketable debt. The sources of public debt includes dated government securities, also known as G-SECs, treasury bills, external assistance, short-term borrowings, and public debt defined by the union government. The union government describes those of its liabilities as public debt which are contracted against the Consolidated Fund of India. This is done as per Article 292 of the Constitution. Speaking about the difference between public and private debt, public debt is the money owned by the union government, while private debt comprises of all the loans which are raised by private companies, corporate sector, and individuals, such as home loans, auto loans, and personal loans. As a percent of the GDP, the union government's liabilities account for a little over 46%. However, if the public debt is calculated as general government liabilities, which also includes the liabilities of the states, then it goes up to 68% of the country's GDP. So that's it for this lecture. But prior to ending it, Educate 247 brings you a comprehensive course for RBI Grade B 2020, which features subjects such as economic and social issues, finance and management, along with comprehensive coverage of current affairs in the form of MCQs. So you can log on to the website and avail the benefits of the full video course. Thank you and happy learning.